Hello, everyone, and welcome to today's webinar, Share Buybacks. Is Shareholder Yield the new key to total return? My name is Matt Hogan, and I'm the president of ETF.com and your host for today's webinar. I'm super pleased to be joined today by my good friend Meb Faber, the Chief Investment Officer of Cambria Investment Management. Meb literally wrote the book on share buybacks. You can buy it on Amazon.com. The title is Shareholder Yield. But more generally, he's been at the forefront of getting investors to think about the new concept of shareholder yield as opposed to straight dividend yield, and we're lucky to have him here today. As most of you know, this is the third webinar in our Generating Income webinar week, offering multiple looks on how to build ETF portfolios that deliver the kind of income your clients need. If you want to view the webinars from Monday or Tuesday, they are available on demand at ETF.com on the Generating Income page of our webinar tab. Before we begin, though, there are a few small housekeeping items I'd like to cover. For today's webinar, you can see at the bottom of your audience console a number of application widgets that you can use to make this webinar experience as interactive as possible. For instance, if you have any questions you'd like to ask Meb during the webcast, you can click on the Q&A widget at the bottom of your screen and submit your questions. After Meb's done with his presentation, we'll try to answer as many of these as we can during the webcast. And if a fuller answer is needed, we'll have the ability to follow up on email. Please don't wait until the end of the presentation to ask your question. Ask them as they occur to you. We'll collate them and get to as many of them as we can before the hour is up. Other things to note. If you'd like, you can expand the size of your slide screen by clicking on the Maximize item on the right top side of the slide area, or by dragging the bottom right corner of the slide area. If you have any technical difficulties, please click the Help widget. It's the question mark icon, and it covers some common technical issues. An on-demand version of this webcast will be made available on ETF.com approximately one day after this webinar is completed, and you can access that using the same audience link that was sent to you earlier. Also, if you've registered to receive CE credits, you will receive an email notifying you on how to get those credits for attending today's webinar. That will be sent shortly after the webinar is completed. But all in all, this should be a great conversation. I know that I'm looking forward to hearing what Meb has to say. So for the next little bit, let's sit back and listen and learn about shareholder yield. Meb, over to you.
Matt, thanks for the intro, and thanks for having me, all my friends at ETF.com. I am dialing in from snowy Terrace, British Columbia. If you don't know where that is, you're not alone. I had to look it up before I came up here. But getting ready to head back to New York City tonight. So we're going to fly through this pretty quick. I'm targeting around 40 minutes. And any questions, again, submit them as we go. So let's get started. So real quick, just about us, if you're unfamiliar, Cambria is a money manager, a registered investment advisor. We're based in Los Angeles. We've been around for almost 10 years now. Manage almost $500 million now. We have some individual accounts to hedge funds, and the biggest push in the last few years is to be launching public funds through active and passive ETFs. We have 5 now, including 2 under the Shareholder Yield banner, and 4 more filed, hopefully to get a few out this year. But the goal really is to disrupt the traditional high-fee world of hedge funds and mutual funds. So active funds that historically have offered products, but for much higher costs. We're trying to do those for much lower. This isn't a theoretical exercise. I have 100% of my net worth invested in our own funds. And if you want to find more information, you can always find some of our research at my blog, Meb Faber. There's over 1,500 articles on there. Our main work website is Cambria Funds. And then we publish some research as well on the Idea Farm. For taking the time out to listen to this webinar, I'm more than happy to send you a free book. We just published our 4th book a couple weeks ago called Global Asset Allocation. Much of the topic that we're covering today is on our 2nd book, Shareholder Yield. Again, if you go to freebook.mebfaber.com, put your name and email in, we'll send you a book. Or, of course, just email me directly and we'll send you one as well. So We'll get started now. And the interesting thing when we're talking about income investing and dividends and just investing in stocks in general, as I start with this slide, because I often don't want people to think that somehow I don't like dividends. I love dividends. You can actually buy this shirt on Amazon, which is where we got the photo. But dividends have long been a mainstay of investing. So if you look back all the way, this is the famous Shiller Dataset going back to the late 19th century. It shows that stocks were a great place to invest. And specifically, receiving dividends and reinvesting them, you did a much better job than had you just had the price return alone. And dividends have long been the steady eddy of investing. Ask many retirees or money managers know that you have the consistency of a dividend. The price returns can be anywhere, as shown in this figure. The red returns are the schizophrenic Mr. Market, right? Every year it could be up, down 20, 30, 40 percentage points. But the blue landscape is what dividend yield looks like over time. So fairly stable income for the most part relative to the price returns, which are highly, highly volatile. And if you look back at what's going to be the common period we'll be looking at in this presentation, and of course you could take this back 100 years, but for reasons we'll discuss later, back to 1982, this shows that simply investing in the S&P 500 versus investing sorting based on dividend yield, you do a much better job investing based on dividend yield. You add about 200 basis points of performance, pretty awesome performance over just the broad S&P by investing in the top quartile or top 20% of the highest yielding dividend stocks. So dividend stocks have been great historically, adding to return. They're even more important now. This is a chart of valuations in the United States stock market. This is the Shiller 10-year price to earnings ratio adjusted for inflation, also called the CAPE ratio. This goes all the way back to, again, the late 19th century and usually has an average value of around 16, 17. That's the dark red line, but you can also see times of euphoria as well as depression where the ratio has been as low as 5. Specifically, best time to be investing in stocks, best starting point in my lifetime, the early 1980s, but also times of bubbles and peaks, certainly in the 1920s, the biggest bubble we've seen in the U.S., late 1999, where it hit a value of around 45, and then the subsequent two bear markets, which had brought us back down to a cheap level in 2008, 2009. We are now up to a value of around 27. The regime matters a little bit, so the dashed line is when inflation is tame, so the 1 to 4% range. Stocks are allowed to be a little bit more expensive, so maybe call it around 20, 21, but certainly not around the value of 27 we are now. What does that have to do with dividends? Turns out that if you're investing in dividends and you're investing in stocks when they're expensive and then when they're cheap, so we just said above or below a CAPE of 17, well, when they're cheap, you get a nice tailwind of price returns and the dividend yield. When stocks are expensive, 100% historically of your returns come from dividends. Actually over 100% because price returns are actually a headwind on returns are actually negative. So if you're trying to come up with an estimate of what you think, we think stocks will be doing in this environment, we actually think they're going to be getting somewhere around the dividend yield. Not too exciting. And somewhat depressing, but it's the reality, and it goes to show that dividends are, of course, important. However, as with anything in investing, you often have to ask yourself, is something changing, or is this a static, is this time different? And so there has been a few structural changes over the years. One of the biggest is the payout ratio, how much companies pay out of their earnings and dividends. This has steadily been declining for the past century, particularly over the past 30 or 40 years. Now, why would that be? Well, it turns out that fewer companies are actually paying out less in dividends. This is a chart of S&P 500 companies paying dividends. And you can see that over time, almost universal, 95% starting in the 80s, and it declined, declined again, and it has since leveled off again since 2005. Well, it's often because of the tax regime. Dividends historically at various points in time have been disadvantaged relative to other ways of paying out cash flows. So long-term capital gains, historically there's been times when they're taxed at lower rates than dividends. And all that says is to a company and to investors, hey, we don't want to receive dividends that they're being taxed higher, so fewer companies pay them out. And the blue lines in this chart show tax regimes where the rates are normalized and they're not at a disadvantage, which is where we are currently, which is a good thing. However, it just goes to show that it has changed from 95% all the way down to, let's call it, somewhere in the 75 to 80% range. So fewer companies are paying out less in dividends. This results in a dividend yield that is much lower than historical. So going back to the late 19th century, historical dividend yield around 4 to 5% now, and I haven't updated this chart in the last year or two, but we all know it's sitting around 2% or even a little bit less. So thinking about why that may be. So quick summary on the first part of the presentation. Dividends have been a major contributor to total returns. Dividends are stable. The portfolios sorted on high dividend yield have outperformed. We don't mention this here, but they've also outperformed in almost every country around the world. It's also outperforming if you sort countries based on dividends. That's a great way to invest internationally. And then dividends contribute more to total returns when valuations are high, where we are right now, so they're even more important. However, payout ratio and dividend yields have been declining over the past century. Why is that? So going back to that old chart where we said is something different this time, and this is old John Maynard Keynes, and he has a famous saying where he says, "When the facts change, I change my mind. What do you do, sir?" So in our shareholder book, we use a graphic at the front talking about a famous, really old, and a lot of different religious traditions story, but also in Hindu and in various other religions. But it's about the 5 blind men and the elephant. They all touch a different part of the elephant, right? And get different perspectives on what they think the elephant may be. In this case, it's researchers that are blindfolded, but one grabs the tail and says it's a rope, another touches the side and says it's a wall. And the whole point being is that if you're only looking at one thing, one part of the whole story, you may get distracted and may get a poor understanding of what the whole may be. And why this applies to dividends, what does it have to do with income investing? Well, if you're a company, if you're an operational company, you can only do 5 things with the earnings you have, the money you have on hand. You can pay it out as a dividend. You can then go buy back stock. You can pay down debt to the extent you have any. You can go acquire another business, or you can reinvest in the business. And most people, the sexiest part is the last one, right? People want to talk about Tesla's new car, or what sort of Apple initiatives. Are they putting out a new TV, or what's the operational reinvestment? And however, it's the CEO's job to go and deploy the capital where it's going to have the highest rate of return. That's it, okay? So that may be one of these various 5 combinations. We highly recommend to listeners a book called man, I just blanked on it. It's either Outsiders or Outliers, but it's about how it's case studies on companies that are out there buying back or their capital allocation decisions, because a lot of people focus only on the reinvestment in the business because that's the fun part, but really there's other, what are the other routes that companies can use to improve returns to shareholders. So we're going to focus on this going forward. And if you look at over time, this is a chart from S&P that looks at how U.S. companies have deployed their capital for the last 20 years. And you can see they vary. Mergers and acquisitions in particular, highly volatile due to the nature of the business cycle, right? They pick up typically around bull markets, and in bear markets they don't have as much activity, but the others have moved in different pieces over time. The one that we're focusing most on is returning cash to shareholders. And so this is a chart since 1982 that looks at simply dividends and gross buybacks. And what this shows is that dividends outpaced buybacks for most of the period until you get to around the mid-late 90s. And ever since, buybacks have been greater than dividends in, I think, every year, and in many years eclipsing them by quite a bit. And say, well, why in the world is that? Is that a structural change? Is that some sort of cyclical change that will reverse at some point? Well, it turns out the SEC passed a new rule. Congress passed a new rule in 1982 that gave companies safe harbor from buying back stock. And it's a surprise to many people, of course, but if you think about it, dividends and buybacks are literally the exact same thing. It's Finance 101. If you exclude a few things like taxes and the payouts in a company's trading at intrinsic value, a dividend and a buyback are literally the exact same thing. So at times, and especially at times where companies have been disadvantaged from capital gains taxes, dividends being higher, they're incentivized to be buying back their own stock. There's other perverse incentives depending on compensation and a lot of other levers and moving factors, but buybacks allow a company to be a little more flexible. Often companies see dividends similar to CapEx. They're fairly low volatility from year to year, so is CapEx, but companies are loath to ever cut the dividends, right? They see it as a terrible signal to the market, whereas buybacks is something they see almost in the same vein as, what do I do with this cash sitting around? Typically, CEOs are horrific at timing buybacks. You know, you see them, like M&A, follow the business cycle, so you'll see a lot of buybacks in say 99, 2000, and then they'll decline and dwindle during the bear market, and then again they'll follow the business cycle. They'll start buying back stock 2007, 2008, and then they'll dwindle, and you're starting to see a lot of them again. So in general, CEOs are fairly poor at the timing of the buybacks, but it's very important to see that the buybacks have become the dominant method for deploying capital to shareholders. Here's another chart. We actually think it's really important to look at net buybacks. This is from O'Shaughnessy. And, you know, a lot of people just talk about gross buybacks. So net buybacks are important to us because a lot of companies out there are issuing stock with their left hand. So they'll issue, say, 2% a year of their market cap in stock for options or ways to compensate employees. And in their right hand, they'll reach around and then buy back that same stock. Well, it's not helping the end investor if you're just issuing 2% and then buying it back, right? But it is important to look at the net buybacks in my mind because you can have the similar situation with dividends. You can have a dividend company that's paying a 2% dividend but issuing 3% a year in stock. And so you're technically, in our mind, getting a negative yield from that. And a lot of income investors, a lot of dividend investors don't think about it that way. But it's really important to think about dilution and both sides of the coin. So who's a fan of buybacks? Well, it turned out that Warren Buffett is. Probably the most famous investor in the world, says, when companies with outstanding businesses and comfortable financial positions find their shares selling far below intrinsic value in the marketplace, no alternative action can benefit shareholders as surely as repurchases. And this is a really important quote for a couple of reasons. One, it goes to show that even one of the staunchest value investors in the world puts a huge premium on buybacks. His partner, Charlie Munger, often says, look for the cannibals, meaning look for the companies that are eating themselves by buying back their own shares. But it's also important to show because Buffett talks about intrinsic value. So buybacks are hugely beneficial if the company is trading below intrinsic value. So if the company's buying back stock when it's trading at 80 cents on the dollar, a brilliant thing to be doing. Really dumb thing to be doing if the company is way more expensive than intrinsic value. However, we've learned already, CEOs are terrible at timing them because CEOs typically are overconfident, right? They almost always believe their own BS, right? They think that their company is always undervalued. So they're typically buying back stock at all times. So it's important that someone like Buffett says, you know what, we'll buy back Berkshire stock when it gets down to around, I think it's 1.2 times book or 1.3 times book, somewhere around there. And what that does is that sets a objective way of valuing the company, saying we'll buy it back when it's cheap. Most CEOs, most companies don't have that methodology, which results in them buying back at the wrong time. So it's really important to be focusing on buying back shares when they're cheap. So this shouldn't still say Buffett, however, but what we're going to talk about is the phrase shareholder yield. So a lot of people use this phrase differently. You know, our definition is actually a little bit different, but we'll use the common definition here, which is saying we're going to look at cash dividends plus net buybacks and call that shareholder yield. So saying it doesn't matter how a company distributes the cash. It could be a 4% dividend yield and no buyback, in which case shareholder yield is 4%. It could be a 0 dividend yield and a 4% net buyback, in which case it'll be 4% as well. Or it could be a 2 of each. You know, Apple is a great example. A lot of people that are either dividend or buyback investors focus on companies, and Apple's a great example where it's the holistic sum of the two that matters a lot more than just looking at dividends. Because if you just looked at dividends of Apple, you'd miss their massive buyback. If you just looked at the buyback, you'd miss their dividends. And so you could ask any probably, 10th grader, your niece or nephew, son or daughter, and say, look, I'll give you two choices. I'll either give you $20 or I'll give you $20 and an Amazon gift card for $20. None of them would ever choose the first, right? But how many investors do you know that say, look, I'm a dividend investor? They completely ignore over 50% of how companies give you their cash back. But the same thing, there's a lot of money rushing into these buyback indices, and you say the same thing to them. Say, well, why would you not look at dividends, right? So you're missing half of the picture. So this used to be a check, but no children look at checks anymore, so we're using gift cards. But it just goes to show, if you explain this to anyone, even at a high school finance level, and say, look, you could have two choices where you're making this decision. Would you like to ignore half of the available information? Very few people do that, but if you look at the dividend and buyback indices, you see that many dozens of hundreds of billions of dollars are allocated to one or the other with ignoring the other part. So going back to the old comment I made about why you have to look at both, and so we use this interchangeably with net payout yield, so excuse this, just shareholder yield of S&P 500 stocks. This is distribution, and the good news is 80% of the companies have a positive yield, so it's dividend plus net buybacks, right? And there's even, a handful on the far left that have pretty monstrous yields. You're looking at double-digit yields, right? In this world of 2% or less bond yields and stock yields, that's pretty incredible. But even more importantly, and a lot of people miss this when they're looking for value stocks. They're saying, I'm just buying the cheapest, and this is why it works great, et cetera. But you're also avoiding the expensive stuff. In this case, you're avoiding the companies that are issuing shares or that have a positive dividend yield, but they're issuing more shares than the dividend yield. We call those the capital destroyers, and it's a non-trivial amount of companies. It's 1 in 5 in the S&P. So if you're buying these companies, you're getting diluted every year, and in some cases to the tune of over 10%, which is a lot, 10 percentage points. So you want to focus on the ones on the left side of this chart, and this is even worse as you go down the market cap range. So if you move into, say, Russell 2000 instead of the S&P 500, this chart gets even worse. Now let me show you kind of one of the money slides of this presentation, and I ran this about a week ago. So this is median yields for the S&P 500. So the blue is percent of dividend yield, so it's median, so the median company that we're looking at in the S&P 500, and then the buyback yield. So you get about a 2.5% yield if you just buy the S&P 500. This is median. Again, it's not aggregate, so it's not weighted by market cap, just the median stock in here. Some of the averages, if you do it across the whole thing, gets a little skewed by some of the companies. But this gives you a really good overview of why we look at this. If you go buy the high dividend yielders, you end up with it's over 3% dividend yield, but not much net buyback, right? Those companies are mainly distributing through dividend. However, if you sort on the top, this is quintile, I believe, of buyback yield, you end up with a low dividend yield, although it looks market-like, but you end up with a monster buyback yield, right? So you end up with a very high percent yield if you sort on the high buyback companies. And this is one of the reasons the buyback indices have been creaming both the S&P 500 and dividends, right, is because investors don't care how they get their yield. All they care, and there's a lot of academic studies that show this, what they do care about is the aggregate amount, right? So the amount that these companies are distributing their cash. These metrics correlate very highly with cash flow values, right? So, and then on the right is high shareholder yield. If you sort it on shareholder yield, you end up with a very similar thing as the buyback. So the same reason that high shareholder yield strategies have been creaming dividends in the S&P and look highly correlated to buyback yield is because right now the companies that are distributing a lot of their cash flow are choosing to do so by buying back stock. All right, so think about that for a minute. And this is maybe where we are in the business cycle, is that buyback yield will be highly correlated to shareholder yield currently. However, if you look at a time like a 2008 or 2009 or in a bear market typically, that buyback yield is going to shrink massively because companies will stop buying back stock. So you'll have far fewer companies buying back a ton of stock. And so all of a sudden, this chart may look a lot different. You know, if I get back invited in a year or two from now and we're in a massive bear market, if we ever have one again, maybe it's 5 years from now, you know, you may have the dividend yields having the monster yield and buyback being very low, in which case you would rather have the dividend yielders, right? But that's the whole point of this presentation, is why would you ever just look at one or the other? It has to be a holistic view. So the shareholder yield will already include that no matter which way you look at it. So I also ran this, which is sort of a histogram of the dividend yield, the buyback yields, and the shareholder yields of different companies, and it shows a few different things. It just shows that in general, dividend yields kind of clump around, the number of companies clump around that 2% range, and it dies off pretty quickly after 3 or 4. But the buyback yields and shareholder yields have a much larger right tail. You know, there's many more companies that are getting into the higher single-digit, double-digit sort of yields based on those metrics. The good news is it works. It works great. This is a chart going back to 1982. If you sort companies by S&P 500, or this is the top quintile of simply dividend yield, buyback yield, and we include a metric in our book called debt paydown yield. It's another way. It's a little more esoteric, but we think it's another way to return cash to shareholders. And it turns out all of those beat S&P 500. These are all market cap weighted. If you do equal weighted, it'll do even better. And of course, shareholder yield beats all of them. And the reason being is that we think it's a more holistic way to view the landscape. We only did this back in 1982. Actually, in a white paper, Wes Gray did it back to 1960s. The O'Shaughnessy's folks have taken it all the way back to 1929. It's worked great over many decades. It's worked even better since 1980 as more and more companies are buying back their stock. Here's a quick equity curve, just comparing the strategies. And it's important to know, and I think this is interesting, that the 2000-2003 bear market was simply a market cap tech bubble, right? So it's the most expensive stocks in the market went through a bear market. If you look at dividend yielders, if you look at the shareholder yield companies, they didn't even really have a bear market. The returns weren't phenomenal, but for the most part, they just kind of cruised on through. Different story, 2008, everything kind of went down. But this goes to show that shareholder yield has been a superior strategy all the way back to 1982. I'm going really fast on this, so hopefully everybody's keeping up. But there's a few more slides I want to squeeze in before we open this up to questions. O'Shaughnessy has also done some work that says, you know what, you don't necessarily just want to stop there. If you segregate shareholder yield into further fractiles of value, so if you're looking at the companies that are buying back stock and paying dividends but are also cheap, and then also quality, so measures of debt or leverage ratios, you find out that those do even better. So you want to sort by shareholder yield, but also only want to be getting the companies that are either cheap and or high quality, performs even better. And two more fun charts, and then we'll shift quickly to something else. This shows dividends. What this chart is, and I'm obviously poaching a lot from my friends at O'Shaughnessy. He's done a lot of great work here. This is a chart of the dividend factor, so dividend yield back to 1960s. The 1960s, yeah. And then the shareholder yield factor. And what this shows is the valuation of those companies, so the top quintile, top 25% based on both, going all the way back to the 60s. And you can see the reason that these two have worked is that they trade at a valuation discount. So if you buy a dividend company, which is usually nothing more than a company paying out a higher percentage of its dividends, earnings as dividends, and is usually more leveraged as well. So it's typically a company you don't really want because it's going to be junkier. But it historically is traded at around a 20-30% discount to the overall market based on valuation. So you're getting a value company, right? So that's the reason dividend yield investing has worked over time. But that varies over time. So while historically it's a 30% discount, in 1999, no one wanted dividend stocks. They wanted Pets.com, CMGI, all the biotechs, right? Dividend stocks traded at a 50-60% discount to the overall market. The biggest fat pitch you've ever seen for dividends when no one wanted them. What's happened in the subsequent 15 years? Well, there's been this search for yield. As bond yields have come all the way down to sub 2 percentage points and dividend stocks have vastly outperformed everything else, what's happened? Well, everyone's rushed into dividend stocks, right? Everyone's looking for income. And this has changed the composition of the asset class. Larry Swedroe has written a lot about this, one of my favorite writers, but it's taken them from the cheapest they've ever been to an actual valuation premium to the overall market. So a lot of dividend yielding companies right now, and you don't have to believe me, go type in your favorite symbol into ETF.com, research, and look at the valuation metrics of the underlying companies, and you will often be surprised to see that a high dividend yielding ETF or mutual fund or whatever you may have is actually more expensive than the S&P 500. That is not something you want. You do not want companies that are higher leverage paying out more of their dividends as earnings as dividends and more expensive than the S&P 500. This is why dividend indices and ETFs have underperformed so much the last few years is because they've simply been expensive. That hasn't been the case for shareholder yield. It's remained at a valuation discount. However, due to that underperformance in dividend yield, if you were to update this chart, you would have likely see dividends come back in. You have a really interesting setup right now where there's a very tight range of valuation in U.S. stocks. They've all gotten more expensive, but it's nothing like 1999 where there was a massive valuation spread between the cheap and expensive. This is a chart, and I hesitate to even include this, so I apologize. It's a lot of numbers, small fonts, but this is dividends and shareholder yield returns, excess returns in many rising interest rate environments going back the last almost 100 years. And what this goes to show, while interest rates may not rise anytime soon, at some point they likely will, whether that's a year from now, 5 years from now, 10 years from now, and typically in those periods, a lot of people, we even saw someone mention high dividend yielding stocks as a substitute for bonds, which we think is a horrible, horrible thing to say. But this just goes to show high dividend yielders actually contribute negative alpha in rising rate environments on average of over 2 percentage points a year in that period. And then U.S. shareholder yield do not. They actually keep up and perform even better. So I think I have about 10 more minutes before we open it up for Q&A. So I'm going to shift into one more aside as you think about income and investing. And this is a chart from my friends at Ned Davis, and it goes to show the we talked about CAPE earlier and how the U.S. market is, if you look at valuation, it's a blunt indicator, right? So it's never exacting, and the way that people want to use it is often the wrong way. But it's a 10,000-foot view, and right now, if you look at CAPE, it's one of the most expensive points in history, right? With the exception of 2000 bull in bubble. It's probably the second highest it's been since that period. A lot of people don't like CAPE for whatever reason, but here's another one. Here's median price to sales ratio of the median stock in the S&P 500. So going back to the 60s, we're at the highest value ever. It's 2.1. Back in 2008, 2009, we hit a value of 0.8. All right, so half of what we are now, in a great, obviously, buying opportunity. And in the early 80s bull market, a much lower value. You'd have a median value of closer to slightly below 1. So we're looking at double the average valuation we've seen for quite some time. But again, this doesn't mean the market has to crash. It could simply go sideways for a while. It could even keep going up and get more expensive. If you look at Japan, the biggest equity bubble we've ever seen, it lasted a lot longer than people thought. It took them over 2 decades to work that off, but it's a good example. So why does this matter? What's the point of this in an income presentation? Well, if you look at world market cap, this surprises people, but people often think that most U.S. investors have about 70% of their stock allocation in the U.S. And if you're a Vanguard, diehard, simple indexer, well, it turns out at a minimum you should have about half in foreign stocks, and no one does, and that's called home country bias, right? So looking at income right now when the U.S. is really expensive, we think it makes a lot of sense to at least have half abroad. And we go a step further and say you should have even more based on valuations, right? This chart, if you went back to the 80s, Japan is only 8% of world market cap now. They were almost half in the 1980s, right, because they had this massive, massive bubble. This is a good example of how you have to think about market cap weightings. And market cap historically has been a horrible way to weight equity indices because it ends up overweighting the most expensive stuff. And a perfect example right now is the U.S. We track the 10-year P ratio for over 45 countries around the world. Here's an update as of, I believe it was last month, but it just goes to show that almost always the stuff on the left, which is what you want to be buying or should be buying, makes you actually nauseous to be even thinking about buying, right? It's Europe, it's Eastern Europe, emerging Europe, but also the problem childs of Russia, Brazil, Greece. These countries have been doing horrifically. Many of these equity markets are in 40, 60, 80% drawdowns. Even the prospect of buying these makes me want to go to tears right now, right? So if you get off this webinar and say, hey, I got some great ideas, let's go buy these countries, you'll probably get fired or told what a moron you are. But a look on the right is kind of the darlings of the best performing markets, but also the most expensive. U.S. is up there around 27, but also a handful of other countries. The good news is most of the world is really cheap, right? We don't even see much of a bubble anywhere. And most of the world is cheap. It just doesn't happen to be the United States. And this is a topic we touch on in Global Value, our book on global valuations. But again, it doesn't matter which valuation metric you use. If you look at a 10-year price to earnings, 10-year price to dividends, 10-year price to book, 10-year price to cash flow, U.S. is one of the worst ranked in across the board. And third most expensive in the entire world. So if you think about a shareholder yield or income approach, it's a little different abroad than it is in the U.S. Most countries don't have the history of share buybacks like we do in the U.S. for various reasons. That's starting to change. You're starting to see companies in Japan and elsewhere over the past 10, 15 years start to buy back shares, and we think that's a cultural difference that will change over time and only increase. So historically, while you may have in the U.S., say, for a good shareholder yield company, a 2% dividend yield and a 5% buyback, that's usually reversed abroad, right? They still like doing it across dividends, so you may have a 4 or 5% dividend yield and maybe a 1, 2, or 3% buyback yield, but it's still important to look at and important not to forget. So when you think about global valuations, with most of the world being cheaper than the U.S., you may think about also applying some of the shareholder yield metrics abroad instead of just domestically. So a quick summary, and then we'll open this up to questions. The dividends have been great. We love them. We think using valuation and dividends to sort companies is a great way to pick stocks historically, been a major contributor to total returns, but we also think it's suboptimal. We think there's a lot better ways of doing it. Looking at a lot of the ways, different ways a company uses its cash flow and then measuring it holistically. So trying to measure how much cash flows companies are paying out, and then also use valuation and quality within those rankings to be able to buy high-quality, cheap companies that are also giving you a lot of cash flows. There's probably not many better ways to invest. That's a very comfortable and we think great way to do it, but also don't just leave yourself constrained to domestic. Think we live in a global world now, over 45 investable countries. Think about looking elsewhere outside of our borders for perhaps more opportunity, especially in the beaten down Eurozone and a lot of the countries that have really struggled. With that, I'm going to wind it up and kick it back to Matt and open up the floor hopefully for some fun Q&A.
Thanks, Matt. Great presentation. Always fascinating to hear and definitely a hot topic right now. I'd remind everyone, if you do have a question for Meb, use the Q&A toggle on your screen. We'll answer as many of them as possible. We've already had quite a few come in, Meb. A few are sort of block and tackly, so I'll start there. The first is, where do you get the data on shareholder yield, and is there anywhere that makes that easily available to people?
First of all, there's not a lot of places. And, one of the reasons people still invest in dividends is because it's comfortable. It's something you get a check, every quarter or whenever it may be, and they've been doing it for their whole lives, right? And buybacks are a little more esoteric for a couple of reasons. One, a lot of companies will announce buybacks and not implement them for various reasons. So the simplest way we do it is looking at just a simple change in net shares outstanding. So you can get that metric from anywhere. It's a little more work. I know a few people have published screeners based on shareholder yield at various places. I know you could certainly get it on Bloomberg or Y charts. I don't know if ETF.com tracks it, but hint, you should. There's a lot of different ways that you could get this metric, but it's still not in the vernacular yet, I think, of the broad financial media. You're starting to see a lot more articles about it. And I think our friends at Alpha Architects even used to have a screener, but it is not common for sure.
Right. Well, I'll get my dev team on it at ETF.com. Certainly the change in shares out is a good way of looking at it. Another question was asking about the immediacy of the correlation between buybacks and price returns on a stock. In other words, if a company buys back 5% of its stock, what should investors anticipate for the future return? Is it as simple as, you expect that to go up 5%? Is the correlation looser? How does that actually play out in real life?
There's a paper somewhere, and I can't remember what it's called, but it talks about the Buyback Echo, meaning it doesn't just play out necessarily this year, but often the outperformance lasts for a number of years, which is a great thing. So what you really want, and this is a little harder to quantify, is you want the companies that have a culture of it and, are and the beauty of this is also that you're avoiding the companies that are historical issuers, right? So even if you weren't focusing on great net buyback companies, if you just avoided the ones that were issuing a ton, you would probably do great as well. Same thing with valuation, right? Just buying the cheap companies is good, but also avoiding the really expensive junk is even better. So it's the buyback effect, but I would impress upon you, it's very similar to, say, a high yield or in dividends. You want someone that keeps it up, but it often lasts for years. It's not necessarily that they're going to do a 5% buyback and the outperformance only lasts for a month. Most of the research we've shown sees that it even if you rebalance these types of portfolios every few years, it works great too.
Great. A few questions trying to poke holes in your theory. One, your presentation sort of has it's a very convincing presentation on why shareholder yield leads to strong performance. One element that you said that goes against that is you said that CEOs are horrific timers of the market, which is to say they buy when their stocks are rich and don't when their stocks are not. I guess, how do you square those two? And then secondly, shouldn't we then, as shareholders, simply prefer dividend yields?
So to the first question, we think it's very important if you're buying any companies, but particularly ones that are buying back their stock. And I'm agnostic. I'm generally agnostic to dividends or buybacks, but you screen for the cheap ones, right? So you screen objectively, and it's easy to do this. You pick your valuation metric. I don't even care. Price sales, enterprise value to EBITDA, price to cash flows, so that you're only buying back the stocks of companies that are cheap and buying back their stock. Also avoiding the ones that are expensive. So like Buffett said, he said, look, we're going to only, so ideally you could prefer companies that are, the CEO only will buy back stock when they're cheap, but we don't want to rely on the CEOs, right? So we'll run our own valuation screens, only buy the companies that are cheap and having a high shareholder yield. Doesn't matter where it comes from in my mind, whether it's dividends or buybacks, I'm agnostic, but it is important to be buying the cheap ones. And so going back to his question of just focusing on dividends, well, no, kind of what we were saying is that it's important to focus on the aggregate amount, not on the transmission method. That's much less important.
Right. Good answer. Now, we all know that there's no such thing as persistent outperformance in every kind of market cycle. So what's the catch here? What's the hidden risk? And when does the strategy lose? And what are the sort of negatives that I should be thinking about as potential risks that you encounter to get the overall benefit over the long term?
Well, I think my chart, where it's Shaughnessy's chart, but my comment where you're looking at factors, so dividend yield being one, and it's an interesting area of research. There hasn't been as much as just pure, just do factors work or not, but certain factors have very long periods of outperformance and underperformance, right? And so there'll be times, like on the dividend chart, where for the last couple years, in my mind, you had to be crazy to be buying these high dividend stocks that are much more expensive than the overall market. You could type in the largest dividend ETF right now. It has a lower yield than the S&P 500, and it's more expensive. I can't fathom why anyone would want to buy that. But why does it have those characteristics? Because so many people have bought it, pushing the prices of those stocks up. So shareholder yield right now, it looks great. And the nice thing is it can kind of adapt to the market environment. If companies are paying it out through dividends and not buybacks, that's where it'll go. If companies are buying back stock rather than paying dividends, it'll move towards those companies. So it automatically self-corrects. I don't have the actual stat of rolling out performance periods for shareholder yield and on a yearly basis versus dividends or buybacks, but it's a very, in my mind, telling point, and that they outperform much more consistently. And so even if you look at it on the per year or per decade time frame all the way back to the 20s, the batting average of shareholder yield is much better than it is for either of the other strategies. And interestingly enough, after we published the book, so not even included in the back test, was one of the highest performing years relative for shareholder yield versus dividend in the broad market, which would have been, I think, 2013, had a monster year. So we think it's pretty stable. Again, if we think the bigger challenge right now is kind of top down rather than bottom up, which is that everything in the U.S. market it's been a rising tide, is more expensive than elsewhere in the world. So I would be looking to apply shareholder yield, especially more broad or with a global focus than just in the U.S.
Right. And why do you think it is that buybacks are less prevalent abroad and higher dividend yields are more prevalent? Is it a mix of the sectors? Is it market development cycles? Do you think that'll change? What's driving that?
Yeah, I mean, it could be incentives too. There can be perverse incentives for companies to buy back their stock if it's compensation related or EPS related. That the tech dominance in the U.S. may have set this culture of option granting and CEO compensation. That's probably a bad thing, honestly. But the shareholder treatment is fairly transparent here, and it's just a lot of the countries, and it varies by country. Some countries you'll see a lot of companies that have buyback activity, but it's also been changing. If you look at the aggregate statistics, a lot of the foreign companies and stocks have been buying back more stock over the last 10 years, and it looks like it's starting to accelerate, which is, we think, a great thing.
Right. We've had a few questions. We don't usually let people sell product, but we've had direct questions about whether or not there are mutual funds and or ETFs that target shareholder yield. So why don't you take that one? Yeah,
there's both. So our first active ETF we launched a couple years ago is a shareholder yield ETF, SYLD. It's technically the largest active equity ETF out there, but that's not saying much because there's just not that many active equity ETFs. But the reason we launched it was because I've been writing about this on my blog since 2006. We called it net payout yield, which was more of the academic term for some of the papers that have come out on the topic. And we used to write about it in the sense of dogs of the Dow strategy, right? So one of the reasons dogs of the Dow strategy stopped working, a lot of people had said, no, it's because so many people were following it. Well, no, the actual reason was it never stopped working. It's just the Dow companies started paying out their cash through buybacks instead of dividends. So sorting based on dividends wasn't picking the highest yielders. It was picking the highest dividend yielders, but not the highest shareholder yielders. So a shareholder yield strategy applied to the Dow 30 has been a great place to invest for the past 30 years. Anyway, getting off topic. There's a handful of mutual funds. Bill Priest's shop, Epic, based out of New York City, runs a few of them. They're typically mutual fund level of fees, so up above 1%. We have two shareholder yield ETFs out, SYLD and FYLD, and then there's an emerging market one that is queued up that will launch at some point. And then, again, there's dozens and dozens of either dividend or buyback ETFs and mutual funds. But, again, you've heard my comments on those. We think all those strategies are suboptimal.
Oh, that's right. And you guys can all research SYLD and other Cambria funds on the ETF.com website by going to ETF.com/SYLD. Let's see. I'll ask one more time. If anyone has any questions for Meb before we wrap up, please enter them into your Q&A tag on your screen. Meb, one small question, not directly related to what you said, but it did hit me from one of your slides. Are there really companies out there in the S&P 500 getting away with 10 or 15% dilution on an annual basis? That seems exceptional.
Being a quant, I would have to go to the Excel sheet for that. But yeah, historically, a lot of the dilutions, they're not necessarily serial diluters that are going to do it for 10 years. But they're the ones that are often, you see a lot of the ones that are issuing shares mopping it up by buying them back, like a Cisco has done for a long time. They'll just go buy back a ton of shares. So it looks like they have a big buyback, but really it's just for the option. So there are a handful. A lot of times it can be, market regime related. So if you're in a fat bear market and they're struggling, they're having to issue shares, or their business is struggling, then you'll see it happen. You don't see it that much where they're all there's a lot of them that are diluting you, because what happens, if you're a shareholder and you're getting diluted 5 or 10% a year, you're not going to stick around that long.
Right. That makes sense. Any closing statements? I guess we have one more question that came in just under the wire, Meb. Someone has been looking at SYLD, noted it had somewhat relatively low volume. Are there any concerns about illiquidity? Any comments you would make about people looking to trade SYLD or get into it effectively?
Well, I'll probably answer this the same way you would, in that if you're thinking about liquidity in an ETF, it very much of it comes down to the underlying holdings. And so if it's a ETF like SYLD or any other ETF, it's got over 200 million in assets and does, 30, 40, 50,000 shares a day. You could call a liquidity provider or your trading desk, and almost universally, if it's a liquid fund like this, investing in liquid domestic stocks, you could put in an order size of quite a large quantity, 50, 100 million, and get filled very close to net asset value, because the mechanics of the ETF, the authorized participant can simply create new shares. And so liquidity is, its size, fairly easy thing to do. Now, if you're just wanting to do it on your own and place your own orders, the simplest way to do it is, of course, to use limit orders rather than market. But it's really a function of what's your size and what's your goal. But in general, we think there's great liquidity.
Yeah, and for what it's worth, we would back that up. If you go to the tradability tab on our SYLD page, you'll see that it rates an 87 out of 100 on tradability, which is a good score. And to back up what you said, we think that its liquidity, its size, is as good essentially as any ETF on the market. So if you're trading 20, 30, 40, 50 more thousand shares, you have all the liquidity you need. And even at small sizes, spreads are reasonably tight. I think with that, I think we've had a great presentation, Meb. I'd like to thank you for being here today and running us through this thought-provoking analysis. I think shareholder yield is an important concept. I'd remind you all that Meb has offered to allow you to get a free book. He is a great and prolific writer. I'd encourage you to take him up on that offer. A copy of these slides and a recording of this webinar will be made available on ETF.com in the next 24 hours. As a reminder, if you register to get CE credits from today's webinar, you will receive an email detailing how to file for those credits. That will come to you as well shortly after this webinar's conclusion. I know everyone out there is busy. I thank you for taking the time to spend an hour with us. I think we've really looked into a new way of approaching the income and yield equation. So thanks to Meb, thanks to the audience, and don't forget to tune in tomorrow for the next presentation in our Generating Income week. It should be exciting. Everyone have a great day. Thank you.